We're proud to welcome you to the Exceptional Advisor podcast series, brought to you by the Investments and Wealth Institute. This series aims to help you to better serve your clients, differentiate yourself from the competition, and enhance your ability to communicate those differences. Hi, I'm your host, Bob Powell. My guest today is Duane Thompson, the president of Potomac Strategies. So welcome to the podcast, Duane.
Thank you. It's great to be here, Bob.
It's great to have you. And before we get started, if you don't mind, for the benefit of our listeners who may not be familiar with you and your work, do you mind giving us a brief overview?
Sure. Well, I've been involved in either government relations and policy analysis, mostly, obviously, financial services for the last 30 years. And for the last 10, I've had the pleasure of working with the Investments and Wealth Institute, tracking the kinds of issues that impact wealth managers and financial planners. And I guess we're going to look at two recent rules that came out.
Yeah, so let's dive in. So there are these two pieces of regulations that impact advice to retail investors: the SEC's Investment Advisor Marketing Rule and the Department of Labor's recent exemption for conflicted investment advice by ERISA fiduciaries. You want to start with the marketing rule?
Yeah, let's go there. That's pretty interesting, and the history actually goes back to 1961. So imagine some people in the audience may not even been born. I was, but when this rule came out, and some people refer to it as the client testimonial rule. But it's much broader than that. It involves advertising by investment advisors. And so that rule, again, came out 60 years ago. And but obviously at the time, the media that you could advertise in was more limited. You had three networks, television networks. You had, radio stations and newspapers. And today, of course, you look around and there's such a proliferation of different ways to reach prospective clients. When the SEC approved this rule last December, they gave a very vague rationale. They said it reflects market developments and changes to advertising and referral practices. And so it's about time we did something about it. But actually, I've been going up to the SEC, meeting with folks up there for years. And even 10, 20 years ago, they were joking, half joking about saying, well, we got to update this rule. But I think what really pushed them to get going on this was social media. And it can trip up an advisor who, in good faith, let's say they have a LinkedIn site, and they get a thumbs up from a client. That's an endorsement. That's a testimonial. And so if you step back and look at it over these 60 years, the SEC, because they never really defined what a testimonial was, they ended up putting out what a no action letter is. That means, you say, if I do this, am I going to be in violation of the rules? So the SEC looks at it and says, if you do what you say you're going to do, we wouldn't recommend enforcement action. So that's what a no action letter is. And so they've issued 400 no action letters over this time period. So there was a lot of clutter and, probably confusion and uncertainty. And, but the bottom line is, up until this past December, for the last 60 years, you could not, client testimonials were banned. I've seen some no action letters in the past prohibitions or guidance from the SEC, where if you had a client that said, Joe over here, my advisor, is a great guy. They're not saying anything about your investment acumen or experience. They're just saying he's a good guy in the community. He goes to my church or synagogue. I like him. He's a solid citizen. And that's prohibited. And I'll give you one other quick example. This is when I was working for the Financial Planning Association, literally 25 years ago. One of its predecessors, I got a call from a panicked investment advisor, a member, I think he was in Connecticut, said the SEC just showed up at my door. They're doing, one of their regular examinations, and they asked me where my solicitation agreement was, because I'm a part of your referral program. Now, that's another rule I'm going to talk about in a second that's related to this, the cash solicitation rule. But basically, under that rule, if you pay someone compensation for a referral, then you got to meet this other rule that requires some disclosures and other things. And so he paid a modest fee to be listed with the organization to get referrals. And so we panicked a little bit. We said, what? We're not out there soliciting. Maybe you pay 50, 75 bucks extra a year or something for this listing, and you may get referrals. So it didn't seem to fit. So that, and we went in and got a no action letter. So that's the kind of things that I think the SEC also said, look, we're spending too much time trying to explain this rule. So social media came in. So, Facebook and other LinkedIn and all this.
So Duane, let me interrupt you for a second. One of the things, when the SEC first put this rule in place, the thought was that that the experience of one client may not be representative of the entire client base. Is that sort of
that's an excellent point, because as you know, with other businesses, you can see all kinds of commercials and ads. My plumber's great and all this kind of stuff. That's okay. But if you're a fiduciary, and I think that's what distinguishes even from stockbrokers, who can, to a certain extent, have testimonials. But when you're a fiduciary, like you said, this one client may have had a great experience with you, but that the SEC said that may not be representative of all your clients. So that's why being a fiduciary puts you in a special position of confidence and trust with the client. And the SEC was very concerned about that. And so it's kind of been this wall that you hit if you're saying, well, how do I market my firm? Well, yeah, and you have clients who love you. You and I over the years have talked to. That's part of satisfaction, right? Of being an advisor is helping out your clients and having this great relationship. And they probably want to say, "How can I help you?" And refer me. I think that's the base. What I've heard over time. It's always referrals. And of course that's great, but if you want to really, especially if you're starting out and you want to expand your business and advertise, forget about the testimonials and endorsements, or the cash solicitation to get referrals is another one. So I don't want to get bogged down, but let me just go quickly, because
sure.
This rule also sort of consolidates. The SEC was thinking of actually just updating both rules, but then it said, let's put them together. So in 1979, the SEC adopted what's called a cash solicitation rule. And again, it wanted to have these solicitors, they were called solicitors, who refer clients to you for compensation, to disclose that they have a financial incentive and a conflict of interest to say, hey, this is a great guy, great advisor, but he's paying me, whether it was cash or something else. So you needed to jump through some hoops, give the client a copy of the agreement and the current Form ADV and all this kind of stuff. So, the SEC finally stepped back when in 2014, they looked at social media. I think that was a driver behind this. They eased up on the pedal a little bit and said, as long as you don't, if someone on a third-party website says something nice about you, you can put a link to that on your website. So they started to ease up a little bit. But you can't cherry pick, if it's something from Yelp 3 people loved you, 1 person thought you weren't so great. You got to put all 4 of them on. You know, you can't cherry pick and things like that. And so finally, they started look at this and said, let's just update the whole thing. And hopefully, if we make it more principles based, we won't have to get all these no action letters and respond all the time. And so they're hoping that irrespective of what kind of technology you're using to advertise, they're not going to have to go back every year or so and take a lot of their time and energy and advisors to give them guidance. Now, I don't think that's going to stop. I think there's going to be questions that pop up. And if you want me to give you a quick overview of what has changed, let me just give a, it would take hours to dig into all of this. So
we'll do the Cliff Notes version then.
Yeah. This is the Cliff Notes version. And essentially, there's a couple key changes to keep in mind. I think one of the most important previously, an advertisement, which would include testimonials and other things, would be communications to 10 or more persons. Ironically, now they're cutting it down to more than 1 person is considered an advertisement if you put something out about your services and all of that. So it's been broadened, and you have to keep records on it. But on the other hand, you can use testimonials now, but they've also the SEC has also defined a difference. They're using a little bit different terminology. So where they called people solicitors for cash payments, they're now calling them promoters. So, for example, anyone listening to this, they have a compliance person or attorney that they use. They're going to start talking about promoters. And also, there's a difference between testimonials and endorsements. So a testimonial, when the SEC talks about that, or your compliance guy does, a testimonial is by a current client, okay? But an endorsement, where someone says, go see this guy, it could be like a celebrity endorsement. It's kind of like that. It's someone other than a current client, and in this case, a promoter. And the other tricky part, where the SEC also looked at third-party ratings. So I think we've all seen in magazines, worth top 100 advisors, things like that. You had to be careful previously. And I'm guessing the SEC had no action letters on this, how you use it, because you may have your monthly or quarterly client newsletter. And, if you're fortunate enough, you're one of the top advisors selected by this magazine. Well, that's okay. You can use that in your marketing or your client communications, but you have to disclose clearly and prominently. So I'm giving you one example on this. You have to put the date of the rating and the time period on which it was based. So if it was a magazine, it was this issue and so forth, and the identity of the party that did it. So here's the publication. Now, if there's some of those situations where you pay some compensation for the rating, you would have to disclose that. So, the one thing I would draw from this is to say, while this is a wonderful marketing opportunity for advisors, especially where they want to use client testimonials and instead of just rely on referrals, you have to be really careful because, as they say, the devil's always in the details. Now, the rule actually goes into effect May 4th. So after that time, you can start using client testimonials. But there's a difference between in when an agency puts out an effective date and a compliance deadline. They're usually 2 different things. So you can do it, and there's a compliance deadline of November 4th, 2022. In other words, 18 months out when it really goes into effect. That's the way I look at it. So what does that mean? That just means you have to be real careful. And I think if you make a minor slip up in what you've, in doing this, using the endorsements, ratings, or testimonials, and the SEC comes in and looks at your books and records, they may ding you. They might put something in the deficiency letter. If you're not going over the top and doing something misleading and really embellishing things,
Right.
telling the client, well, here's what you should say, all this kind of stuff.
So do you mind if I interrupt for just a quick second? But this way I understand. So if I'm Bob Powell, RIA, and you're Duane Thompson, my client, and you say, Bob has done a really nice job of helping me achieve the retirement I desire, quote unquote, and I print that in a newspaper ad or publish it on my
website,
Facebook or LinkedIn account.
Yeah, that's gonna be okay. Now, and you can even, I really appreciate this, Bob, but you could give me a nice dinner too. Say thank you, I appreciate that, as long as it's under $1,000. Now, maybe if I'm in Boston, we might run into problems there, but no, I'm joking. But that's one of the exemptions. If the endorsement or the testimonial is, the compensation being paid to the party is under $1,000. Right. Then you don't have to go through a lot of these disclosures and other things. So I was, kind of using that in a joking way to say that there's a de minimis amount where you can pay someone or compensate them. But if it goes over that, where you're actually paying someone to do that, then that becomes an endorsement, or you have to disclose for the testimonial of a client. But I think in the situation you just described, that's what we're going to see with a lot of advisors. They have clients who love them, and then you say, hey, can I put a written testimonial from you on my website or something like that. Right. It's not going to be a problem. You just want to be careful. Now, I'll just mention one other area of this rule that gets really complicated, and that's portfolio performance. Your performance. People are going to naturally ask you about that, and all I can say is, this gets into really complicated territory. And there's different kinds of performance, related performance, extracted performance, hypothetical performance, predecessor performance, things like where I used to be on a team of advisors, and we had some really good portfolios and things like that. You would like to use that. So that's that's related predecessor performance, or for example, extracted performance is taking a subset of your investment portfolios and using that to illustrate your investment skills and so forth. So all I can say is talk to your compliance person, and if you get into portfolio performance, be real careful.
Yeah, it strikes me that that's a bit of a sticky wicket, because you might have clients that have growth-oriented portfolios, and some have income-oriented, and some have conservative or preservation portfolios.
And they want to say, what can you do for me?
Right.
And let me just tell you, it's pretty obvious, because that rule is over 400 pages. Okay. And maybe this is my rule of thumb. I just do a word search sometimes through the document. So for example, a 430-page rule, I looked at hypothetical performance, and that phrase is mentioned 278 times. The others, related performance, are about 70 times each. But it just shows you that that's an area of concern for the SEC. So again, if you want to look out for some areas where the SEC is going to express concerns, or you might have problems, it's going to be in portfolio performance and how you advertise it in your client communications. The other thing I would say is talking to your current clients about your services and so forth, and you could that may be the newsletter that you send out to all of them. that's fine. That doesn't really fit under the perform advertising rule and so forth, except if you're offering a new service or something, then there's a potential where that would come under this advertising rule, where you have to keep records and other things and be a little bit more careful. So I think there's a lot of good news in this. I'll mention one other thing. Well, how will advisors use this? I just saw a study this morning, I think it was by American Funds, where they said advisors rely too much on referrals. It's one of those stories. And maybe that's all you need to do. If they're spreading, but again, like I said, if you're a new advisor, or you're young, tech savvy, and you want to grow your business, you may say, "Oh, these testimonials are great." So it's really hard to say how this will be used. And I would say, okay, we're still in the middle of this public health emergency with the pandemic, and so you're really not getting out probably as much and circulating face to face. So it may be that advisors that used to go out and invite a prospective client to dinner or some sports event or something like that, where they're not, so they may say, hey, well, this is a good way to really be able to market myself.
And I have to think that for the folks who are listening to this, members of the Investments and Wealth Institute, that there will be a good number of RIAs who start to incorporate testimonials into their advertising, and that to not do so may be to be left behind, because everyone will be promoting the fact that their clients love them.
Yeah. Yeah. Are you looking at your competition in your city or something, and suddenly you start seeing testimonials pop up on the main page of their website, and you say, I want to keep up.
Yeah.
So,
what do you think could go, if you're an advisor, aside from getting into trouble with the SEC? What's the downside to doing this from your perspective? Is there something that people need to be wary of as they think about this?
Well, I'll go back.
Unintended consequences.
Yeah, I'll go back to the original premise for this rule. Is you're a fiduciary. So there's a lot of documentation involved in almost anything you do. And this rule is no different. So if you say, testimonials are great, I love them, just make sure you understand the rules, the constraints, and make sure you're in compliance. And again, this rule has enough tricky parts to it. You want to talk to your compliance person before you really take a deep dive into this, because there's enough tricky parts into it in it that you want to be careful.
Let's keep the lawyers busy, I guess.
Yeah.
We won't dive into this now, but years ago, when I worked at Dalbar, I was among the hundreds of people that applied for a no action letter on the testimonial rule, and we did receive one. And ultimately, it entailed us being able to survey the entire client base of an advisor and then use the aggregate rating as evidence.
I remember I read the Dalbar no action letter and all that, and they did. It illustrated that would be, under this rule, a third party rating, I guess, and you had to be real. The advisor was sort of arm's length away from the ratings that were done and so forth. So yeah, that's a perfect example of why the SEC will still be concerned in how ratings are used by an investment advisor.
Yeah. So do you want to turn our attention to the Department of Labor rule with respect to great. So
okay,
I'll leave the driving to you.
Yeah, and this is another rule which is typical at the end of an administration. An agency takes a while to get going, to get confirmation of the political appointees and so forth. And so this was a rule that was kind of neglected, because this is an exemption for giving conflicted advice under ERISA. And ERISA is the highest standard under law for fiduciaries. So the SEC took, and of course there was that controversy. This goes back to 20 16, when the Obama administration came out with a fiduciary rule, and industry groups challenged it, and finally, I think it was March of 2018, that rule was overturned. So I'm just framing this, and so in the absence of that, where a lot of industry groups were relying on several different exemptions to give advice, simply because I don't think conflicted is necessarily a dirty word, and under ERISA it means that you have a conflict because you got a commission, and you had to be able to, as a broker or insurance producer, and you had to be able to disclose the conflict of interest, because you technically at least had an incentive to push maybe certain products to your client, or recommend certain products to your clients over others. And so so what the SEC, rather what the Department of Labor did, was broaden the definition of fiduciary to create a higher standard for brokers and insurance people who recommended annuities and retirement accounts and so forth. Whereas investment advisors as fiduciaries probably were already in this space, although again, this was a higher fiduciary standard than actually what you had under the Advisors Act. And you say, why? What's the difference? One of those is that you have to benchmark your compensation. It has to be reasonable. And so an investment advisor, certainly, if you're way out of whack, but usually, with retail clients and taxable accounts, as long as you're within the ballpark of what other advisors charged, you were okay. But the SEC wasn't likely to come in and say, well, your benchmark is, you're not really close to the benchmark of say 1% assets under management, things like that. They're not as sticky in that area as ERISA is. Plus, you can be sued by clients directly and not have to go into arbitration under ERISA. There's what's called a private right of action. So what I'm saying is that that's when you're dealing with retirement accounts and giving advice either to the plan or to the individual account holder, you have a higher standard when you're dealing with IRAs and 401k accounts and things like that. What happened? The Fifth Circuit overturned the Obama rule, and what the Trump Department of Labor did was put in sort of a temporary enforcement policy. They said, well, okay, you can give conflicted advice as long as you adhere to what was called the impartial conduct standards. And that's basically, the duty of loyalty and prudence, make sure you're acting in the client's best interest. The recommendation is suitable at the time it was made, that you only charge reasonable compensation that I mentioned earlier, and you don't omit important information or make misleading statements and things like that. So it was pretty basic. And in the meantime, the Department of Labor and statements and the SEC both said, we'll let the SEC take the lead this time. So that's when we saw a regulation best interest come out. And because the SEC doesn't regulate annuities other than variable annuities, that's left up to the states. The state insurance commissioners came out with their version of Reg BI, regulation best interest for annuity transactions. And Johnny come lately is it's Department of Labor, but they wanted the SEC to take the lead. So they are trying to roughly provide the same type of safe harbor or for conflicted advice that the SEC put into place for brokers. But there are some differences, because just the statutory requirements under ERISA are different from the 34 Act and FINRA rules, but they're not that different. But anyway, let me just give you, just the short. What's new under the Department of Labor's rule? It pretty much brings in the impartial conduct standards that were under that temporary enforcement policy, And then it just adds a little bit more paperwork. You have to make required disclosures of those conflicts. You have to try and mitigate any conflicts of interest. And then I think this is there's two real important areas. The first is that you have to have a senior executive in your excuse me, in your firm sign off, do an annual review and a sign off on policies and procedures designed to, have compliance with this rule. But in some ways, it's really not that different. If you're already regulated under regulation best interest, there's really not a lot of differences. Now, of course, one interesting aspect is under the DOL rule, you have to disclose fiduciary status. So that's it's kind of an irony in a way. So you may be a broker and where you don't have, Reg BI says, look, you're not a fiduciary. They say that up front. Whereas, you may be a registered rep and you're giving advice to a client using the safe harbor. Well, I'm a fiduciary. So that's one of the reasons consumers get so confused, because here's one person giving advice on the same account. I don't think they're going to go out of their way to explain that I'm this conundrum that, okay, I'm a fiduciary under ERISA, but I'm not under securities law. But that's the way this stuff operates, because, you have different overlapping laws that may apply. Now, the other important area is that as I mentioned, there was this old 5-part definition that the Department of Labor put in place in 1975 that basically made you a functional fiduciary if you met all 5 parts of this test. So outside of investment advisors, most brokers and insurance producers were able to rely because they never met all 5 prongs of this test, so they weren't fiduciaries. So they could give advice and to plans and to 401k accounts and all that without getting dragged into fiduciary status. And I'm not going to get into the 5-part test, other than the key part is you have to give advice on securities or investments on a regular basis. So if you just sell a annuity product to put in someone's account, IRA or something, and you're not going to be meeting with them on a regular basis, you're not going to be a fiduciary. You're not going to meet that standard. However, what the Department of Labor did do with this latest prohibited transaction exemption was say that if you give rollover advice, and that's a big deal right now. It's been that way for 8 or 9 years for regulators to look at rollover advice to see what kind of conflicts of interest. You can't casually say, yeah, I'll take it and put it in an IRA without doing some due diligence work. But what the Department of Labor said here is that if you expect to meet on a regular basis with this client, once they roll over their assets, whether it's to another 401k plan or to an IRA, et cetera, so you're going to be giving them advice on a regular basis on this rollover distribution, then you're a fiduciary. You meet that regular basis test. And so that's an area. Again, I know most investment and wealth institute members are already investment advisors and fiduciaries, and they charge AUM and so forth. So it's probably not going to be as big of a deal for them. But if it's someone who isn't normally operating as a fiduciary, they're truly registered rep, and so forth, they have to pay attention to this, rollover advice. You have to, hopefully document the basis and explain the reason for the rollover, and you have to look at factors that might suggest that they shouldn't roll over. Maybe the the administration of the 401k account isn't being paid through the plan. The plan sponsor, the company, is paying it all out of pocket. So typically the fees for the client go up when they move out of a plan. And you may have institutional share classes in the plan because you have more purchasing power. So the investment cost is going to be much lower. Plus, if you hadn't been advised by a wealth manager or so forth, and they go into an IRA, then the advisor stands to benefit. So they have a conflict of interest in suggesting they roll over and you manage the assets and so forth. So that's always been for the last 7 or 8 years for the Department of Labor, SEC, states, FINRA, rollover advice. So that, to me, that's one of the big parts that someone who's looking at rollover advice for their client needs to look at. Well, how am I registered in providing this advice? What capacity? Am I giving them advice as a registered rep or as an investment advisor and so forth? And do I need this safe harbor? So it just gets really tricky. And I think, in terms of whenever those two words come up, rollover advice, be real careful, make sure you do your due diligence, and make sure that if you are going to recommend a rollover, that it's in their best interest. And it may be that, yes, it's going to cost them more, but it depends on the services you provide. In Reg BI, I'm getting on a slight tangent. They for the first time really start to put more emphasis on investment cost as well, to act in the best interest of the client as a broker under Reg BI. But they emphasize, and this is true as an ERISA fiduciary as well, you don't always have to recommend the lowest cost investment. So in other words, if you have more of an active management philosophy, obviously the investment options that you select are probably going to be more expensive, or it's going to take more of your time, as opposed to a passive investment strategy and using index funds and all of that. But there's no prohibition or requirement, prohibition on active management or requirement that you always select the lowest investment option. So you can, if they need a micro cap or a small cap investment, that's going to have a higher investment costs than S&P 500 and all these kind of things. But you have to just be careful and document the basis for why a more expensive investment option is being recommended, things like that. So, yeah.
So it strikes me that if you're an advisor who's giving lots of rollover advice, that you might need a template that evaluates different factors like, I don't know, cost of the funds, number of funds available, creditor protection, et cetera, and looking at all the pros and cons of leaving it where it is or rolling it over, and then documenting that for the client file.
And with some of my clients, I've done checklists for them on rollovers. What do you need to look at? That's a reason to stay in the plan if you can. If you're leaving, if you're leaving the employer, there's some advantages again to staying in the plan, and there may be other reasons to move to either roll over to another plan or roll over to an IRA, et cetera. But it's the same way with switching accounts. So forgetting about rollovers, again, now I'm getting more into Reg BI territory, but maybe most advisors are duly registered with the investment advisor side and the broker side. And so you may be talking to a new client, and the SEC gets into a lot of discussion on this. What capacity are you acting under Reg BI or under the Advisors Act and so forth? And so that's a facts and circumstances test. And that just gets back to the point that not so much with the IA marketing rule that we just talked about, there's not a lot of overlap. At least that's straightforward. You're an investment advisor, here's what you have to deal with. But when you get into the Department of Labor's new rule, and exemption for safe harbor for conflicted advice, you're probably wearing at least two hats Well, you have to be wearing at least two hats. You're wearing your ERISA hat, and you're either acting as an insurance, maybe you work for a bank or broker dealer, investment advisor. So you really have to make sure you understand what overlaps. And if somebody says, well, what do I do? Especially since, we're seeing all these changes in administration. So you're probably going to see the Biden administration tighten up its regs. They probably have a few things in the IA marketing rule that they want to change. Reg BI, they're probably going to do some things in there. So, but if you operate at the highest standard, among the areas that you are that are applicable to the advice you're giving, not to mention, if you're a SEMA or a CBWA or a CFP, et cetera, you have those higher private sector standards that you need to. So the default is basically operating at the highest standard that comes into play. And then there's a good chance that you're not going to have any problems with any of the other regulatory overlap that comes into play. But it does get confusing because I know a lot of folks have at least two different licenses and all of that.
Yeah. So remind me, the new rule is effective when, and the safe harbor is available until when?
Yeah, no, I don't think I mentioned that, so thanks. The Department of Labor's rule actually went into effect February 16th, but you can still use the impartial conduct standards, which is the temporary enforcement policy. That's called, I think it's called FAB, Field Advisory Bulletin 2018-02, until 12 months from now, or 12 months after it went into effect. So around February 16th of next year, you can rely on that, the impartial conduct standards, as a safe harbor, which is probably a good way to, and that's what the SEC and Department of Labor is doing. They want to give advisors a substantial transition period to make sure they get their new compliance systems in place. So for the advisor rule, it's 18 months, starting from May 4th. And for the Department of Labor rule, it's just about 11 months for getting your compliance in order.
Yeah. So my guess is if you work for a large firm, Merrill Lynch, UBS, their compliance departments are pretty
all
in place.
Yeah, they're all over that, and they're going to give you the kind of guidance you need. But if you're a smaller independent firm, obviously you made a decision to not have a back office or to have say a compliance person on retainer, and you probably have to do a little bit more homework on your own.
Right. And if you're an RIA and you custody at Schwab or Fidelity or Pershing, hopefully they're giving you some guidance too.
Yeah, they'll probably have some handouts and maybe some webinars. One thing I did forget, going back to the advisor rule, I know most of your audience is probably going to be registered with the SEC as investment advisor. The marketing rule doesn't apply if you're state registered investment advisor. You have to look at state rules. Now, what's the other tricky part is, I don't think it's a lot of states, but if you're registered with some states, like I think Ohio, they will incorporate by reference in their law SEC rules in some areas. So you might be okay with the testimonials in some states, but if not, what's called their model unethical business practices rule that the states have in place, they're like the SEC was from 1961. They banned testimonials. So it helps keep me employed. I'm sorry to say that, but keeping track of all this stuff that's going on.
Well, so I guess two questions come to mind. One is, as you think about Reg BI, the Labor Department rule, the current administration, do you see efforts to harmonize more so than in years past, or is that sort of
I think the Obama administration went through that, and I think it was partly because Mary Jo White was SEC chairman at the time, and Phyllis Borsey was Assistant Secretary of the Department of Labor. They were both busy. They were in their own silos. Mary Jo White, she was an enforcement person. She wasn't really looking that much at coming up with a higher standard for brokers. So they were just in their own silos doing their own things. And the industry complained over that, and they said, let the SEC take the lead. So I think in the Trump administration, there was more attention to coordinating these rules, but they're all locked in to a certain extent by what the statutes themselves say. So I hate to say it, but until it gets to the point where all these different regulations pile up and you have barnacles that just become so frustrating. I'll just go back real quick and say this is back under the Bush 2 administration. They kind of started to look at major reform and say we should just break it up between basically banking rules and sales rules and put everything under one or the other. But that's going to be a huge catfight because, the states, the agencies, they're all jealous of their jurisdiction. So if and when that ever happens, it's going to take years for Congress to be able to come up with what you might call sense rules. Here's what you do for a retirement account. They'll probably just forget about, just have one standard for whether it's a taxable account or a retirement account. Say, here's how you give advice. But that's way down the road, unfortunately, I think. Yeah. But they are starting to, they're converging on cross-marketing of services and doing the same thing. So I think the regulators are starting to move out of their bunkers a little bit and talking to other regulators.
Yeah. So if memory serves, I think you wrote a primer on Reg BI when it came out for Institute members. Will you be writing something similar with respect to the marketing rule or the Labor Department rule for the benefit of members?
Yeah, I can see IWI wanting to do something like that. Yeah, I wrote something to say here's how you harmonize your compliance under 3 different rules, and boy, that's not easy to write, and it's challenging. So all I can say is, it's. When I started in this, like I said, actually 25 years ago in securities and financial services industry, it's just every year things change. So you got to stay on your toes.
You did talk about job security a second ago. So before we wrap up, is there anything that you've already mentioned that you want to just reemphasize, or anything that you haven't touched upon that you'd like to bring up before we wrap up?
Well, it's just kind of the closure on this. If you're doing the right things for your clients and I think it's important to develop a fiduciary culture within your firm, because you have sales regulation technically on the books as a broker and on the insurance side, and you had the advice law on the books for investment advisors as fiduciary. But the regulators are moving inevitably towards an advice standard, even under their sales rules. So again, operating under the highest standard is the best way to kind of eliminate some of the headaches that are involved in trying to sometimes comply with 3 or 4 different laws for giving the same kind of advice is all I can say. Yeah. Well, Duane, this was an entirely complicated subject matter, and you've done a great job of uncomplicating the complicated, as always. Oh, hopefully it helps a little bit, but it's always a pleasure, Bob. Thanks.
Thank you for listening to the Exceptional Advisor podcast, brought to you by the Investments and Wealth Institute. If you've enjoyed this podcast, please subscribe through iTunes, Spotify, or our website at www.investmentsandwealth.org/podcast to get the latest episodes of our Exceptional Advisor podcast series. For additional resources, updates on events, and exclusive membership deals, visit www.investmentsandwealth.org.